let's move on now, and let's get you, a snippet of that sort of exclusive conversation we had. This is a CNBC TV18 exclusive. Rajiv Jain of GQG Partners is one of the largest foreign investors in India currently, with India investments of some $22 billion, global investments of almost $130 billion. I spoke with him, and he explained his thought process on investing in the infrastructure space. I mean, his big bet is on the big infra build-out. Airports, for example, is a big area. But I began by asking him how India, because they invest in markets around the world as well, how India compares with other large developing markets, especially those which are similar to India, a good mix of public and private companies. Listen in. Hello and welcome to this special edition of Market Masters. I have with me today Rajiv Jain, Chairman and Chief Investment Officer of the asset management firm GQG Partners. Although Rajiv has enjoyed a storied career with market-beating returns for a long period of time, he really attained celebrity status here in India when he boldly bought into the Adani Group companies last year. At a time when the group was going through tough times. That bet, by the way, has already paid off spectacularly well. With assets under management of nearly $130 billion globally, two of which are in India, GQG is a force to reckon with and is also one of the largest investors here in the country. Welcome to the show, Rajiv. It's a pleasure with us here.
Thanks for having me.
Rajiv is an investor who sort of, looks at markets across the globe and invests across the globe. How does India compare, especially those where there is a good mix of public companies and private companies in the stock markets?
Yeah, Prashant, as you know, there are a few very large emerging markets, and India is one of them. There has, in our opinion, over the last 7-8 years, and that's beginning to diminish. So I think if you look at the larger markets, India, Brazil, Mexico, and so on and so forth, India, I feel, is one of the best. So if you leave aside everything, simply look at corporate earnings growth over the last 5 years, which is basically pre-COVID till today, India has amongst all emerging markets as such, right? So far better than Chinese, which I feel this doesn't get enough airtime, that at the end of the day, earnings drive market. And when corporate earnings are as strong as it has been, generally the market will follow. And India, Brazil, Indonesia have been some of the best, but India has actually been remarkably strong corporate earnings growth.
Do you think we are pricing a lot of that good earnings growth, Rajiv?
Well, that's $1 million question, as they say. I'm not so sure. I think I feel that markets typically climb the wall of worry, and there's always angst about having run up so fast, that there could always be a pause. But if you take a slightly longer term view, I feel that India still has quite a runway. I'm talking about sort of 3-year horizon. So the valuations are maybe a bit extended, but not crazy. So because you always have to look at the runway in front, and the runway is fantastic. So if I look globally, actually, the two markets that I feel have the right dynamics for very strong returns, one would be, after US, I would say, would be India and Indonesia.
Mm. And even in terms of returns over the last couple of years, I think India and US are right up there, right, in terms of
Yes.
returns that they've given. And just to sort of press on that point, 1 minute longer, one refrain, one hears quite a bit nowadays is that there are no worry on the horizon. I mean, things are looking absolutely clear. In fact, I've even heard someone say the only thing to worry about, that there is nothing to worry about. Now, that sort of thinking is basically inviting trouble. I just wanted your perspective.
Well, things always come from unexpected areas. For example, if something goes, Middle East could flare up a little bit. Oil prices could be higher for longer, and there could be a spike. I mean, those are the classic India worries people have. Oil prices, although I think there's less impactful than used to be for various reasons. I think the biggest worry should be that a lot of mid caps have run up quite a bit. So could there be a pause? Entirely possible. And then markets, have these 10-15% sort of shakeouts, or some people call it the pause that refreshes. There's nothing wrong with those pauses, but I think fundamentals are reasonably robust. So we're actually kind of in a glass half full, not glass half empty mindset. We do feel that it is not a bad time to be kind of a risk on, despite the run up. I'm talking about globally. What we've seen you also have to remember that this is an election year in US. Election years typically means that there's more stimulation, whether fiscal policy or monetary policy. Inflation is reasonably well behaved. So from a global cross currents, I think the whole inflation spike that we saw 2 years ago is kind of behind us. Some of the forward leading indicators of inflation are actually pretty benign globally. And that has implications on monetary policy. And the elections generally means that politicians typically in US also, you would see more stimulus. And that tends to bode well it's more kind of more short-term view, not sort of 2-3 year view.
Okay.